Okay, you guys, so welcome one more time to lesson number 7. So 2 lessons today, just getting ready for the week. So at this point from the previous videos, you are basically getting an introduction, okay, an introduction of just getting out of the confusion of candlestick patterns, indicators, algorithms, chartism, breakouts, channels. That is not the way the markets are being ruled today. So the idea at the end of this lesson is that you get a point of seeing where the focus is when it comes to price activity. Okay, so now I've been talking a lot lately with some some colleagues and traders that they use chartism, and they're just kind of getting into price action, and they've been in the market for even longer than me, maybe like 22 years, and just on and off in the markets, on and off, trying here and there, trying bots, trying whatever automized surveys are out there, and they cannot get to be consistent over time. And I tell them, look, that there is not such a thing as understanding the behavior of the market with anything that is automized, because just the market is being manipulated and is being drove by traders, by money. So how can you get a system that can get everything automated if there's not such a thing? There's no computers out there that are trading for you. Okay, so some hedge funds, some banks, they may have their systems, right? But at the end of the day, it comes to the point where everything is actually emotions in the market. And if you don't understand how those emotions operate, then you're going to be one step behind all the time, trying different systems and trying different things that are not actually reading the market. They're trying to guess where the market is going based on, again, numbers and algorithms and stuff. But the market is pure emotional. The market is 100% pure emotional. So the one that has to be understanding and being one step ahead of those emotions is you when you trade. But once you get into understanding the price activity, you know where the emotions in the markets are, it's so much easier. You won't get caught up on that. Okay, so I was going to take you really quick to how price action is studied and what is the mainstream of price action. Okay, because there is a mainstream, which is applied for many other things. So I want to take you here, how price action studied it. And basically the mainstream here is behaviorism. And I'm sure you know what it is. I mean, it's just the repetitive behavior of the markets and how the buyers and sellers behave over time, that it's shaping the price curve, the price activity of any instrument, and that's basically behaviorism. Okay, so price action equals market inaction, and that is the behavior of buyers and sellers. Okay, so behavior does not provide guarantees about the future. It can help us to analyze historical data that is available in order to better understand how our actions impact the financial market. This is very important right here. This is a very good point. Okay, so we're not trying to guess what is the future going. Okay, what we're trying to do is to understand where are the buyers and where are the sellers, and based on that you can plan your strategies of the day. But we don't know where the market is going. We don't know what the highs are. We don't know what the lows are. We don't know what they're going to be the highest of the day of any instrument. We don't know what the lowest of the day of any instrument is. We know when the crash is coming. We don't know when the crises are coming. We don't know any of that. And we are not supposed to know that anyway. Okay, so that will keep you with respect to the market. That will keep you in aligned with just all you need to know is what are the buyers, what are the sellers, today, tomorrow, and the day after. Okay, so by being aware of our behavior and recognizing patterns, we can become more effective and strategic in our decisions. So what that means is, I'm not talking about patterns on charts. I'm talking about patterns of historical data. How do we know that, for example, the pound dollar above 130 is into buyers, below 130 is into sellers? How do we know the gold above the 1900 is 100% pushing for buyers, below 1900 is 100% pushing for sellers? How do we know those sort of things? How do we know that today, if the euro is quoting above the 107, we have chances to go for the buyer? And if it's quoting below 107 in a short day, in a sell day, opening hours, then we're going to go for the seller. So those things that when I'm saying patterns over time, every single year that the price on the euro dollar is trading below 110, the buyer are not interested in holding their trades. So the buyer is only for 1 day, 2 days, 3 days, and then the seller is going to try to push the price even lower because they do not see the value of the euro below 110. They don't want to hold it as a valuable asset or currency, actually currency. Okay. So that is the behavior that we're talking about here. I'm not saying that I'm checking the charts and looking at support resistance and candlestick patterns, all of that. That's not what we're talking about here. We're talking about the recognition of the market when the price was trading at certain levels, at certain prices. And then after that, the recognition, the exact strategy that is convenient to trade on that day, on that price, how we're going to move around those prices on certain day. Okay. So as we continue to study this field, we may find even more ways for people to better understand their attitude towards and reactions to favorable and unfavorable market conditions. Okay. And that is, for example, when you see a crisis coming, when we see gold trading into lower prices every day for 1 week, or 2 weeks, or 3 weeks. So we know that the reaction of the buyer is going to be even stronger when you are at the lowest of a week, of 2 weeks, or a month, or a year. Okay, so the market may see it's unfavorable conditions for gold, but I know that the buyer in their head, they're also considering that because it's a crisis coming, the market, or there's going on a crisis, the market might tend to go for gold, for example, or for silver, when that's actually not the case. When we have crisis, gold, it's very easy to see that if the buyer is really not into the market, they won't push gold. And gold is going to be trading lower and lower and lower. So what price action may be complicated to understand at first, because I understand that I'm switching your perspective from charts to price activity, and I'm not showing you any chart yet. I'm not showing you anything yet. So I need to just get really into the understanding how the market behaves first, how we're gonna think in terms of market activity, and just get out of the trying to look for patterns and charts and breakouts and Bollinger Bands and all of that. Okay. So unlike other strategies, price action does not use indicators for decision making, but rather relies on your individual judgment of market opportunities at any given time. So here's when you put your emotions on the field and on emotions on the market, and you know that, oh, you have a high of the day, you have a high of the week, you have a high of the year. Get ready for the seller to go higher. Get ready the seller to actually buy, and it's so easy to scalp it that way. Okay, so the most important concept is not only to understand price action factor in trading, but also applying in with scalping techniques to maximize success. And again, because if you don't, I mean, in my case, the scalping is going to keeps me in the present moment, and my ego is not involved on anything, because I'm not saying, okay, that will be the highest of the day, so I'm going to hold my buy and my long position up to that target. I'm going to hold my short down to this target. So when you scalp, you are in the present moment. You divide market range in 1, 2, 3, 4 trades, whatever it is that is giving you, and also will keep you to be alert and to react on time. So it's actually some, emotional situation, the emotional situation there, that is also beneficial to get the most advantage without your ego getting involved in your trading and saying, okay, today is, up to whatever high or up to whatever low. So try to think scalping that way, because I've seen people saying, oh, scalping is in 1 hour, a 1 minute time frame. So your trade must be hold in a 1 minute, or scalping is 7 pips or 7 ticks or 10 ticks. So they try to put the scalping technique into a frame that has nothing to do with time frames, with the timing that you're gonna hold your trade, or the how many ticks or pips you're gonna get the trade in the market. So there's no such a thing as that. Scalping means be in the present moment, take advantage of your market intervals that the price is presenting you, and once you're ready, you're out, you exit your trade, and then wait for the next opportunity the same way. We're gonna get to scalping a little bit more in deep, but for now, just keep in mind that is something that will help you to keep your emotions in the present moment without guessing what is the market is going and what is the future of whatever price today, tomorrow, or for the next week. We don't analyze, we trade. You're not an analysis. You don't do analysis here. You're a trader. So leave the analysis for Goldman Sachs, for all those big guys that they're paid for that. But just don't get caught up on those analyses saying, oh, this year the euro is going to be traded in a buy pressure area above 112 with high risk. And because that's what they said, and it's not happening. So when I heard that, I'm like, okay, we'll see. So once we start trading below 110 this year on the euro, for example, I'm like, how this is going to happen if the dollar keeps pushing interest rates higher and higher and higher? How the euro is going to make it through that? So anyway, just bear in mind that we don't do analysis here. We think in terms of price activity and how to take advantage of every single price movement of the day. That's all we're doing. Okay. So with patience and attention to detail, you can unlock tremendous profit by taking advantage of short-term price changes in the market. Okay, so the buyer-seller curve is an incredible useful tool in understanding the pricing of an asset over a period of time. The buyer and the seller curve, I'm going to show you what that is. So by plotting out buyers and sellers on two axes, it enables us to map out its buying and selling points in relation to each other, helping us to identify market areas and market strategies. Okay, so along the historical information that we count on with the markets, with whatever instrument you want to have in mind, it's been always the buyer and seller interaction. So let's say we have the financial market since the 45, even from the 30s, right? And with all that analytical information, we know what is the buyer, what is the seller, how the market reacts on highs, how the market reacts on lows. Okay, every year you do the map price of an instrument, whatever you want to do from the markets, so you know what is the buyer, what is the seller, how is the interaction in the market between the buyer and the seller on different prices of the entire instrument activity. So that's, I'm going to help you how you set up that also. So it was found great success in economics, helping investors study the relationship between buyers and sellers, the curve that I'm talking. However, as we've seen here, this idea can be adapted for use in many different applications as well. With understanding this concept of the buyer and seller curve, you now have a powerful tool available to help you better understand price action and make smarter decisions about how to trade. So this is the curve that I'm talking about. You got the seller or the offer and the demand or the buyers. And along, this is the, let's say, the market is moving towards the future. Okay, so the market is moving towards the future, right? So buyers and sellers, that interaction over time, gives you certain prices that along the way, those prices have an interaction between what is the buyer interested to hold and what is the seller interested to actually go short. What is the buyer interested to buy and hold? What is the buyer only interested on the opportunity of the low and then get rid of the buy? And that, because also remember that the price goes down because the buyer are getting out of the trade. And that's when the short and that's when the seller jump in the trade and you take advantage of that. There's no such a thing as of sellers, only sellers. There's got to be an interaction of buyer and seller. That's why the equilibrium price moves every single day, day by day, it holds to equilibrium. And when they lose the equilibrium, that's when you have buyer speculation, seller speculation, buyer's pressure, seller's pressure along the way. Okay, so that interaction between buyer and seller is what, again, it creates the curve that I'm talking about. Okay. This is a very easy concept if you see it like that. It is being applied for many other economics studies. And trading is actually matching perfectly to this analysis. Okay. So one more example here, how we get to this, and then done with this quick lesson, which is, again, the mainstream of price action, which is behaviorism. I'm sure that you know about it in economics, if you're coming from economics. So, by the way, I study international relationships as a degree, and I have a master's degree in management projects. And in international relations, we had, like maybe 4 semesters of economics, macroeconomics, economic 1, economic 2, international economics, international finances. So it is amazing how all of those main things that I studied, it applies perfectly to trading. And and I wasn't sure if I was going to do this when I studied in university at college, but it happens, it happens that because when you do international relations, you want to be a diplomatic. That's what the career will shape you to be, basically. But that is my second year. I was like, that's not going to happen. So I'm just going to get my degree and then I'm going to be a trader. And that's exactly what happened. I was only 23 by then. But anyway, it was amazing how all those, semesters were actually perfectly matching the economics behind trading. And that was pretty cool. So let's give an example here. If a pound of sugar in the supermarket is too expensive compared to what the consumer will be willing to pay, there will be an excess supply and a shortage of demand. The price should go down in order to reach an agreement with the buyer and be able to sell. Well, this is exactly what's happening in the market every single day. If a pound of sugar is very cheap, the opposite would happen. There will be an excess of demand and there will be not enough supply, since it will not be convenient for the producer. If you know and understand and grasp this concept right here in the markets every day, you know exactly what I'm talking about. At the end of the day, the buyer and the seller will agree on that the pound of sugar maintains its equilibrium price, and both parties participate in the market the following day. So they agree one day how much it is, so they come back the next day and know what the price is, and they speculate above it or below it. The same phenomenon takes place in the financial market. Market always tends towards equilibrium, always. Because if there's no such a thing as equilibrium price or equilibrium in the market, it will be actually really unstable if you think in terms of the demand and supply. And at the same time, if the market will be always in equilibrium, always in equilibrium, then the price will be just flat every single day, because they will agree every day in how much the S&P 500 cost, and how much the euro cost for the dollar, how much the yen cost for the dollar, every single day the same way. Okay, and there's no such a thing, because the fun of this is to know when the speculation starts and how to catch the market on the right moment when the speculation begins. And that's when the news fundamentals take place. So this will help you to shape your thought, to shape your behavior with the market when you see that they're going to try to find the equilibrium. They're going to try to find where to balance each other, and then what's going to happen next. Who wins from the equilibrium price? It's a fabulous concept. And once I get you to the market, once I get you to charts and everything, you're going to see so easy that you will never know why you were wasting your life and time with charts, indicators, and all that, since it's just buyers and sellers. It's you and me fighting for the markets to know who wins that day above certain price, below certain price, who wins the speculation of the day, and who takes the most advantage from each other, the buyer from the seller and the seller from the buyer. I'll leave you this right here. Remember to check on my website the article I'm about to give, the update of the projections for next week, how we'll project the euro based on the activity of past week. And it's going to be right here for you. Remember to get here an English version, because everything's in the main language, Spanish, okay? So you're going to find it there. If you want to trade with me, of course, you are more than welcome to join me. You can go here to plans, and you can start off with 1 week, try 1 week for $10. And then if you're happy with the result, then I'll see you on the membership, or for free. You also can trade for free with me on the free version. And for that, text me or email me at the email that you see here in the contact, on the contact tab. Again, most of the material that I do is in Spanish, but my live trading sessions are both English and Spanish, so there's not a problem of language if you want to be training with me. I'll leave you this lesson here. I hope you enjoyed, and thank you for your support on these channels. It's pretty new, but I'm glad you're enjoying the content, and I'm glad that I can help you to improve your trading one more day. And thank you so much. I'll see you next time.